The greatest threat to the American economy is not the artificial intelligence bubble. It is not China. It is not the politicians sitting in the Oval Office. It is a structural crisis sitting completely ignored in Tokyo. The mainstream financial media is selling you a dangerous, pacifying illusion. They have anchored retail attention exactly where they want it, on tech stock momentum, election cycles, and Washington's daily theater. That is noise. The real systemic crash trigger was not pulled in New York or Washington. It was pulled in Tokyo in 2024. We are talking about Japanese government bonds. For decades, Japan functioned as the invisible duct tape holding the entire Western financial apparatus together. Now, that tape is violently peeling off. In 2024, the Bank of Japan officially terminated their yield curve control policy and hiked interest rates for the first time in 17 years. Then they hiked again. The foundation of global liquidity fractured the moment that decision hit the wires. Look at the raw data. Look at the tape. The mainstream anchors called it a routine pullback. It wasn't. It was an involuntary margin call. It was a no-win call. Immediately following that second rate hike, the S&P 500 rapidly dumped 6%. In Tokyo, the Nikkei 225 plunged over 12% in a single trading session. That was the largest, most violent single-day market collapse since the Black Monday crash of 1987. This was not a localized panic. This was a cross-asset forced liquidation event. When the Bank of Japan abandoned its zero-rate regime, they detonated the core assumption, keeping global asset prices inflated. The cost of global capital changed overnight. The mainstream crowd is still glued to their screens, waiting for the Federal Reserve to cut rates and save their portfolios. They're staring at the wrong central bank. The era of free Japanese liquidity is dead, and the global repricing has barely begun. The mainstream financial media is selling a catastrophic lie. They are calling the 2024 cross-asset bloodbath a routine rotation, a healthy correction, random market volatility. They are wrong. This is not a random retail panic. This is the forced liquidation phase of a multi-trillion-dollar machine. Now the tape. This is strictly educational, not a signal, not advice. Stop staring at the S&P 500 hourly chart, looking for support levels. You cannot read the candle without understanding the global liquidity structure supporting the candle. The structure is breaking. The yen carry trade was a cold-blooded arbitrage. Borrow yen at near-zero interest rates, convert those cheap chips into US dollars, and blindly buy US treasuries yielding 4%. After stripping out the hedging costs, they pocketed the massive spread. The peak scale of this trade was estimated by institutions at trillions of dollars. Global tech stocks, American real estate, emerging markets. They were all fundamentally running on Japan's free Wi-Fi. When the cost of capital is zero, you buy everything with a pulse. The entire construct rested on one fragile constraint. Japanese borrowing costs will remain at zero forever. That assumption died in 2024. When Japanese yields broke upward, the logic instantly inverted. Borrowing yen became more expensive. Hedging the currency risk became exponentially more expensive. The foundational logic of free money was completely destroyed. That 4% US Treasury is no longer a brainless money printer. It is a toxic liability. This is a hard break in the cost of capital. When the cost rises, the capital flows forcefully reverse. The margin calls are unforgiving. The selling is indiscriminate. The momentum chasers are sitting frozen, holding their long positions, waiting for Wall Street bailouts. The institutions driving the tape are ruthlessly liquidating positions. They are unwinding a multi-trillion-dollar trade. The free money era is permanently closed. For 30 years, Japan was not just a participant in the global financial system. They were the duct tape holding it together. Now the primary anomaly. The 1992 asset bubble burst. Real estate collapsed. equities crashed. Japan entered 3 decades of absolute stagnation. No real growth, no inflation, no wage expansion. The Bank of Japan glued interest rates to the floor. They implemented yield curve control, capping long-term bonds by force, whether the market liked it or not. This is the constraint that built the modern American debt structure. Facing 0% domestic yields, Japanese institutions went shopping overseas. Japan launched a multi-decade global shopping spree, becoming the largest foreign holder of United States Treasuries and one of the absolute largest buyers of U.S. mortgage-backed securities. This was not a geopolitical favor. This was absolute necessity. The United States runs trillion-dollar deficits annually. The Treasury must issue a catastrophic volume of new debt simply to keep the economy functioning. Supply requires demand. With that debt issuance constantly growing, someone has to absorb it. For decades, Japan was the critical absorption machine. They were not just random buyers. They were the most stable, price-insensitive buyers on the board. Stop obsessing over Fed press conferences. Powell is the wrong lever. The Fed controls short-term rates, but the long end of the curve, the 10-year, the 20-year, the 30-year is dictated almost entirely by raw supply and demand. The Japanese absorption machine is violently shutting down. When the largest foreign buyer of U.S. debt steps back, the bid disappears. The supply of U.S. debt is accelerating. The primary institutional demand is cratering. This is a terrifying supply and demand black hole. Verify this yourself. The reports are public. Pull the Treasury International Capital data. Pull the U.S. deficit projections. When Tokyo stops buying, the structure breaks everywhere. Now the macro escalation. Capital does not have loyalty. For decades, capital flowed one way, out of Japan into the West. Now, that flow is forcefully U-turning. This is not a cyclical adjustment. It is a structural repatriation. The cheapest, most abundant source of global liquidity for the last 30 years is actively draining back to Tokyo. The mainstream media wants you fixated on the Oval Office. They are blinding you to the plumbing. When a price-insensitive buyer leaves the auction, the floor falls out. The momentum chasers are praying for rate cuts. They do not understand the risk repricing channel. The bond market is the absolute foundation. It is the risk-free rate that dictates the return on every single asset class in existence. When the supply and demand structure of that foundational bond market breaks, a specific violent chain reaction follows. Long-term interest rates spike relative to short-term rates. The currency debases. Capital flees the sovereign debt market and surges into gold. Global bond market liquidity is evaporating right now. This is capital making a deliberate, quiet judgment about where real value resides. The ones who verify the data are tracking the sovereign debt exit. The repricing benchmark for every stock, every mortgage, every corporate loan is resetting. If the anchor of the global financial system is pulling its capital home, your portfolio is in the crosshairs. Now the honest case for caution, because balance is what separates analysis from promotion. The structural thesis is absolute, but timing the unwinding of a global sovereign bond market is a dangerous game. Sudden policy shifts can aggressively alter the timeline. The Federal Reserve could panic. They could abandon their mandates and deploy unlimited quantitative easing. Stepping in to directly monetize the debt is the buyer of last resort to replace Tokyo. That synthetic liquidity injection would temporarily override the bond market. It would trigger a massive, artificial melt-up across risk assets. If you are positioned purely for an immediate systemic collapse without accounting for central bank manipulation, a sudden liquidity flood will liquidate your portfolio before the fundamental reality ever takes hold. The market is being sold an extremely dangerous lie. The mainstream financial media repeats it every single day. A Federal Reserve rate cut automatically equals financial easing. That is propaganda. Supply and demand govern these markets. The Federal Reserve only controls the overnight rate. They do not control the long end of the curve. They can slash the federal funds rate as aggressively as they want, and short-term yields will drop. But if the largest foreign buyer of United States debt permanently leaves the auction, the long end of the yield curve will be violently pinned to the ceiling. Long-term yields will remain stubbornly, structurally high. That is the exact mechanism of a steepening yield curve. Institutions buy the cash flow. The ones who verify the data know exactly what a pinned long-term yield means for equities. It is a compression of stock valuation models. Wall Street analysts use the long-term Treasury yield as the absolute baseline to discount future cash flows. When that long-term yield remains elevated, the present value of all future corporate cash flows drops. The trading multiples contract. Asset valuations are fundamentally strangled from the bottom up. Earnings can beat expectations, and the stock will still collapse because the cost of capital underlying the valuation has permanently reset. Real estate is paralyzed because the 10-year yield is its gravity. Mortgage rates anchored to long-term bonds, not the Fed. Waiting for 3% rates is an impossibility in this structure. A short-term rate cut without long-term bond buyers does not create easing. It creates a steeper yield curve, and a steeper yield curve suffocates the real economy. The cost of capital is experiencing a violent, systemic reset. The transmission chain of a global liquidity drought is cold-blooded. Look at the corporate credit markets. Read the tape of the 2020 and 2021 cheap capital era. Capital was a limitless, functionally free commodity. Corporations issued massive tranches of debt at heavily discounted rates. That artificially cheap funding pumped equity valuations and blindly accelerated deal flow. That era is permanently closed. Borrowing costs are now structurally pinned high. Persistently high capital costs directly force a plunge in corporate risk appetite. They suffocate economic growth and relentlessly tighten capital allocation across every single sector. Liquidity is the oxygen of the financial markets. When the single largest foreign holder of United States Treasuries takes a step back, the global oxygen supply collapses. This is not a localized event. When global liquidity tightens, the baseline cost of capital mutates everywhere. It strangles everything in its path. It compresses stock market valuation models. It pins residential mortgage rates to the ceiling. It chokes off corporate credit lifelines. Stop trading the headline noise. While the media sells a pivot narrative, smart money is quietly exiting. Your only mission right now is survival. You must protect your capital based purely on the underlying, hard data of supply and demand. The global bond market does not care about your portfolio. You are navigating a structural repricing, not a sentiment cycle. This is financial warfare education, not advice. Protect your capital. Invest with logic, not hype.